Welcome, everybody. Oh my God, I'm live on Instagram at the same time. Everybody's being live on Instagram, so I thought I would give it a shot. Well, we are live on YouTube for our daily touch base episode 130 on the Martinis with Scott channel. Hope everybody is doing great. Hi to everybody on Instagram. I don't know if I can pay attention to two things at once. Maybe if I move this phone over here, is that going to help me? How's that? Everybody can see everything. Now I've got myself in stereo. Who wouldn't like that? Hey, quick touch base today. We have our Thursday 4 p.m. Eastern drink this afternoon. So please come join me. I just shot that show, and what I touched a bit about on the show for this afternoon is investors and a risk reward of debt versus equity, which was a question that came up on Clubhouse the other night. So the real question was, you're an entrepreneur, you've got a high growth business, you want to bring in some investment. Should you be considering equity investment or debt investment or some combination? What are the pros and cons? It gets very complicated for the average entrepreneur. How do you deal with that? So I just want to touch on a couple of points. Some of it is repetitive with this afternoon show. Some of it are new points. The part that's repetitive is not nearly as in depth. But the first of all, as an entrepreneur, you need to always remember for your own pitch, for your negotiation, for the way that you think about investors in your dealings with them, what is it that investors want? And at the end of the day, what investors want is they want to know how they're going to get into the deal, how they're going to get out of the deal, how they're going to be protected, and how much money they're going to make in between getting in and getting out. So let's have a quick chat about that. I know that was on Instagram as a meme earlier this week. What does getting in mean? I'm an investor. I want to step into your business. What does getting in mean? Well, what are you selling me? What is the security? Are you asking to borrow money from me? Is that debt? And if so, what are the terms? Or am I buying shares from you? Are you selling me a percentage of your business, X number of shares? What am I buying? And what is the value of that security that I am buying? What does this say? We're telling you followers that you started. Yeah, okay, cool. The Dr. Dapper joined us. Dr. Dapper, this is my very first ever Instagram live. I do a live YouTube on the Martinis with Scott channel, just a daily touch base. And I thought, why not record this on Instagram this week as well? So that's what's up, Dr. Dapper. Thanks for joining us. So investors want to know, how do you get in? How do you get out? And how are you protected in between? So if you want me to invest in your business, are you selling me stock? Are you selling me shares? Are you selling me debt? Do you want me to loan to you? So how is that going to work? That's the getting in. I want to know, how am I getting out? I'm getting out as an investor. How? If it's debt, when are you paying me back? How do I get some comfort that you're paying me back? If it's stock, if I'm a shareholder in your business, here's what entrepreneurs usually forget to think about is, how am I getting my money back? How am I getting my money back? How am I getting return? How am I getting my value? There's often only two ways. One is you have to sell your business. 3-5 years from now, you need to sell your business, or you need to go public, which means you're selling a part of your business and you're raising cash. And I'm allowed to sell my stock into the market, right? And not many businesses get to go public. So if this is just a normal business, you're an everyday entrepreneur. Not that entrepreneurs are ever every day. If you're going to take investment, you need to think about how you're going to get out. I was on Clubhouse last night, and I was talking to a contractor from Edmonton who was thinking about bringing investment into his business. He was thinking about doing that as equity. He's a contractor. He's not going public. There's no scenario where he's going to build his business and go public. Therefore, how is he going to get money back to this person? The only answer is to sell the business in the future if it's a share deal, okay? So how do you get in? How do you get out? And how much money do you make in between? If it's debt, if you want me to lend you money, what is my interest rate? What is the return that I get from doing that? And if it's stock, what you need to do is you need to value your business in the future. Here's how you're going to get out. I'm going to sell my business. Here's what my business is going to be worth. And here's what you're going to get out of that if everything goes to plan, and you want to tie the valuation of your business to the investment. So in other words, if you're taking money from me to grow your business to the next level, whether that be another revenue level, do a strategic acquisition, whatever it is that you're doing with your investment to take your value from here to there, then that's what you want your valuation to be tied to, and your exit periods, 3 years, 5 years. So it depends on how long it takes to grow that. But don't ignore that the investor needs to go out. So many entrepreneurs that I see forget that. I got a little bit more time. I talked about on the Thursday afternoon show, what you're going to see, Dr. Japer, 4 p.m. Dr. Dapper, 4 p.m. Eastern. We do an actual martini with Scott. So jump in and watch that show. That is not live, but there's in-depth. There's a turnaround journey on there with Navani Stainless, and there's more in-depth on risk reward. But the bottom line is, Jeff, welcome to the show. This is my first ever live Instagram. I do a live YouTube every day. Jeff Pocock joined. He's M&A guru of Canada, maybe of North America. He'll admit that I taught him everything he knows. So you've heard all this before, Jeff. So if you're an entrepreneur and you're taking in investment, how do you know whether you want debt or equity? Well, listen to the show this afternoon, but the paradigm that I need you to think about, the frame of reference, is risk reward. As an entrepreneur, if you're taking in debt rather than equity, you're taking on more risk. Why? Because you have to pay it back, and you're taking on less. So you're taking on more risk, but you have more reward because you haven't diluted yourself. If you're taking equity, if I'm putting $1 million into your business as a startup, as an entrepreneur, I put $1 million in, you take $1 million from me in equity. Well, you have less risk because you don't have to pay that back. It's not debt, it doesn't have an interest rate associated with it, but you've diluted yourself. Okay, you now own less of your business, and if you own less of your business, you have less reward in the future. I gave you some examples of that on the show this afternoon. I won't repeat it here because we try to keep this to 15 minutes before I go to my next meeting. Last point I want to make for entrepreneurs on the investment side is cost of equity. Everybody thinks there's no cost of equity. If I go borrow money from Jeff, who's got lots of money and wants to lend me $1 million into my business, he's going to tell me he wants a 10% interest rate, right? So there's a cost. I have a cost to that money of 10%. Make it a 12% interest rate is a percentage a month. What is the cost of equity? Well, there's no cost to equity, Scott, because it's just dilutive. I don't have to pay it back. There's, we need to exit, but we share in that pain. Well, that's just dead wrong. You don't get to see the cost of equity, but I'm going to let you in on a little mathematical secret. The cost of something of your capital structure is mathematically the inverse of your multiple. So you hear people say, well, I'm going to sell my company for 10 times earnings, and we'll forget about the whole EBITDA thing, which confuses people. But just say net income, and this company is going to trade at 10 times in the future, I'm going to sell that. Well, 1 divided by 10 is 10%. Okay, that is a 10% weighted average cost of capital. Let's say you can borrow for every dollar of equity you have, you can borrow 3 times in debt. So there's a 3-to-1 in a normalized capital structure. You do the math on that, what you're going to find out is the implied cost of equity is 25%. It's a 25% cost of equity that's buried into that calculation, assuming your debt is, say, 5%. I forgot to give you that key variable. I know Jeff is building a spreadsheet on this as we speak. So if your debt is 5%, your WACC, your weighted average cost of capital, is 10%, well, your implied cost of equity is 25%. On a really stable 10 times multiple business, what if your business is trading at 4 times, let's say? Well, that's a 25% weighted average cost of capital. Your cost of equity is large. When you're a venture capitalist, what are you looking for? You're probably looking for in the 40-60% range. Capital cost of equity capital is really expensive. It's way more than debt, but it's hidden. So you don't see it. So never forget that. If you're an entrepreneur, you're looking for money, think about risk reward, think about debt versus equity, think about all the complications. I gave you a bunch more examples this afternoon. We talk about when debt starts to act like equity with kickers and conversions and all these sorts of cool things. And we talk about, so I can, as an investor, I can have my cake and eat it too, and you just lose no matter what you do. We talk about when equity starts to act like debt through shareholders agreements and controls and all those sorts of things. So check that out on the show. This has been an experiment on live Instagram. Dr. Dapper, how did it go? Is this working on Instagram? I've literally just put my phone on my computer for the live YouTube. Welcome, Hunter J. Cole. I think I'm reading that right. And that's it. I'm signing off. We do this a daily touch base on YouTube for 15 minutes. And maybe if people like this, we could do it on Instagram as well. Hope everybody's doing well. I am going to disconnect from the YouTube. Thank you for listening. And